Well, good evening, everybody. Good Wednesday evening to everyone. Thank you for joining us for another educational session here at Level Financial Advisors. I'm Mike Hebron, the Chief Operating Officer for the company, and I'm happy tonight to present this topic. It's been something that many of our clients have been asking about. It's in the news everywhere: cryptocurrency, Bitcoin, blockchain, all sorts of different terms being thrown around, and lots of questions. So in order to help our clients and people of interest to get through the topic, we've invited Apollo Lupescu, who's a vice president at Dimensional Fund Advisors, to come and talk with us tonight about the basics of crypto. A couple of words about Apollo. So Apollo started with Dimensional in 2004. He has a PhD in economics and finance at the University of California, Santa Barbara. During his tenure at DFA, Apollo has gained experience in a wide variety of practical subject matters. He was part of Dimensional Investment Strategy Group, worked directly with financial advisors in the Northeast to assist in the development of their businesses, and managed the internal client services team that provides broad analytical support and oversaw the firm's national advisor retirement business. He's currently Dimensional's Secretary of Explaining Stuff. I'm sure that's the official title. In this role, he frequently presents around the country and the world at financial advisor conferences and individual investor events. Prior to joining Dimensional, Apollo had his own consulting firm, which provided services to the U.S. Department of State and the White House on a variety of projects. His interest in finance and investments led him to teaching engagements at the University of California, Santa Barbara. In addition to his PhD, Apollo has a BA from Michigan State University, where he competed in and coached water polo. So before I turn it over to Apollo, just a couple of parameters for the webinar. First, we want it to be interactive. So if you have questions along the way, please feel free to use the Q&A window at the bottom of your screen. We will read your questions back. If we have to interrupt while we're presenting, we'll get that going so that we can answer those right away. We're going to be recording the event in hopes of distributing out to everybody afterwards so they have a copy of it. And so I think what we can do now is we're going to get started. And when I stop my share here, I'm going to go right over to full screen mode. And what we would ask everybody to do is go up into the right hand corner of your screen, click on the view menu, make sure you're on speaker view, and then click on full screen so that you can get the full impact of the presentation from Apollo. And so I'm going to stop talking now. I'll hand it over to Apollo. And Apollo, good evening, and let's get right into crypto. We'll start with the basic question: what is cryptocurrency?
Well, first of all, thank you for the invitation, and thanks to everyone for taking the time. Let's dive right in. Where does this come from? What's the big idea? Because you hear so much about it, and I think a lot of us are curious to know: is this something that we should consider? Are we missing out by not being part of it, or perhaps are we smart by not jumping on the bandwagon? So, cryptocurrency is this idea of electronic money. And it's something that it's been around for a long time. They've been, over the years, going back to the 1980s, there have been various attempts to create digital money with different levels of success. But this cryptocurrency, the way that we know it today, really emerged back in about 2009. And what happened at that time, an individual or group, nobody knows, it's anonymous up to this day, published a paper. It was a very short 8-page paper, 9-page paper, so short enough and sweet, and it kind of laid the foundations for what they wanted to create, which is a digital currency. Instead of using dollars the way we use dollars, we've used it so far, the idea was to create some electronic form of currency payments that would solve a couple of problems that these inventors thought that need to be addressed. And the first problem was that they thought that the dollar bills and currency in general, it is put out by governments. And the government has control over how much of these dollar bills get put out in the economy. And if you go back to 2009, there was a lot of concern at the time that with a program launched by the Federal Reserve called quantitative easing, along with TARP, which is a troubled asset relief program, along with the government spending, was putting a flood of dollars in the US economy. And some folks felt uncomfortable, like the government has, can just print as much money as they want, and that's not a good thing. So the idea was to create a currency that from the very beginning, it will have a finite amount. In other words, you can't just print forever, but there's a limit. And once you reach that limit, boom, there's no more of that currency. So creating something that's more scarce than what they saw with the dollar bills. So that's the first problem that they're trying to solve. The second problem that they're trying to solve is the fact that right now, if you want to have a transaction, so not that Michael and I will exchange payment, but let's say that I wanted to send my cousin or my brother in San Francisco, I want to send him some money. Well, from my app on the phone, it has to go to my bank. From my bank, it has to go to his bank. From his bank, it has to go to his app. There are a lot of nodes, a lot of intermediaries in transferring money, which makes it inefficient because everybody, not only that it takes longer, but everybody tries to take a little bit there, and it ends up making everything, the whole system, inefficient. Talk about credit card payments. Obviously, if you pay with a credit card, it goes from the merchant to the bank, and everybody takes a cut. So it's quite inefficient. So the idea was, can we create a transfer system where it can go from one person to the other directly with no intermediaries, and that would streamline and facilitate payments. And those are the two, in my view, those are the two main ideas that cryptocurrency was designed to do. And to accomplish that, what this paper outlined was a very clever system of keeping track who owns the money. Because right now, you know that you owe money because you have the physical paper or you go to the bank. What they said is that instead of having institutions look after who owns what, they created a system called blockchain. And the idea of blockchain is, instead of having one centralized entity that either issues currency or keeps track of who owns it, a system of ledgers, a system of just computers who would keep track of every single transaction that has ever happened among these currencies. So if I have some, let's say Bitcoin in my account and I want to transfer to my brother, that transaction is getting written on maybe thousands of computers around the world at the same time. So everybody has exactly the same record of who owns. So that gets subtracted from my account, added to his account. Everybody in the world knows that. But it was also a level of anonymity, because I can create a number of accounts so nobody knows it's me. And that was the idea back then, to also create a bit of anonymity, which is not really a big deal for most people. Frankly, I don't care. I'm pretty transparent with what I do. So the idea was to create this network of computers that have these ledgers. And in order for these transactions to be validated, there was a little bit of like a mathematical puzzle that a computer had to solve to validate that transaction. And that gave rise to something called mining. So in order for these transactions to actually go through and be validated by the system, a computer has to validate it. And that miner who used the computer and the computing power to validate that, well, they get paid in new Bitcoin. So the way the new Bitcoins are created is that you have this system where somebody uses their computer, they validate transaction, and then they get paid through new issuance of Bitcoin. And that blockchain technology is really clever. And my guess is going to have plenty of uses outside of the Bitcoin itself. But to me, it's important to understand what is the difference between Bitcoin and blockchain, because a lot of folks are kind of mingling the two. The truth is that blockchain is a technology that can be used for many, many purposes. Keeping track of who owns what property, keeping stock of who owns what stock. So it doesn't have to be, it's a very clever system that can be used for many, many applications, Bitcoin being just one of them. So that to me is the idea. So if you understand what blockchain is, it's just system of keeping track of who owns what, that everybody sees, a publicly ledger, and every computer writes exactly the same transactions. And then Bitcoin being this form of payment. Now, if you fast forward, Michael, to 2021, and he asked the question, has Bitcoin fulfilled its promise of becoming a currency? The answer is absolutely not. It is not a currency. Let's just, in my view, it is not a currency. As much as people want to think about it as currency, it is not as currency. Why? Because the currency has three features. This is clearly documented in all the economics book, and just intuitively. There are three things that make the dollars and the euros what they are. The first feature of a currency is that it is a store of value. And what it means in plain English is what I could have bought a month ago is roughly the same that I can buy this month and roughly the same that I can buy next month. And that is the store value. Think about it. The money that you have in your checking account could have roughly bought the same things today as they did a month ago, as they will a month from now. That's the idea of currency that has value, is a store of value. And if you think about it, Bitcoin is absolutely not a store of value. Why? Because from day to day, Bitcoin, it's either worth $60,000 or it's 40,000 or it's 50,000. Huge changes in value every day. So you can't really rely on Bitcoin to give you that stable value because it fluctuates way too much. And we all know how much it fluctuates in value. So it is not a store of value. You can't preserve it because it fluctuates too much in value. The second thing is that it is a unit of account, meaning that prices are quoted in that currency. I know right now that a gallon of milk is about $4 here in Los Angeles. I know how much a coffee is. I know, how much things cost, a gallon of gas or whatever. Nothing that I know of is quoted in Bitcoin. I have no idea, what prices are in Bitcoin. So nothing gets quoted, but we all know what it is in dollars. And the third one is it's a medium of exchange. In other words, it is accepted as a form of payment. And I don't know about you folks, but I've never bought anything with Bitcoin. Even if I had, I don't know anybody who has Bitcoin that has bought things with it because it's really not practical. In order for these transactions to be written on the blockchain, well, it takes some time. It actually takes quite a bit of time to go through this, solving of the puzzle. So if you bought a coffee today, you might have to come back in a few hours and hopefully that transaction was validated. So it's not really possible to be a medium of exchange. It has become a medium of exchange in one area, and that is illegal activities. All the hacking, all the ransomware, most of it only exists because of Bitcoin. And frankly, I'm a little pissed off, and I don't want to be part of anything that hijacks people's medical records and doesn't give them back until they pay a ransomware. So I kind of really dislike the fact that Bitcoin is used so much for illegal activities. There was an estimate that about 3/4 of all transactions in Bitcoin are for illegal purposes. So there's a medium of exchange. It's just not what we would think of. And so in that respect, none of these features are making this a currency. And the fourth one, which I think is so interesting, is a currency is whatever you pay your taxes in. And as long as we pay the tax in the taxes in dollars, it's going to be really hard for anybody to say it's a currency. So none of these features really fit the bill for Bitcoin to be a currency, which was what it was designed to be. Still a clever idea, still interesting. It's almost like a solution in search of a problem, because I'm totally fine with the dollars. I don't need to hide myself. I can go buy with dollars. So for me, for example, Bitcoin doesn't solve any problems. Now, it is possible to argue that in some countries that really have unstable currencies, this might be more stable than their own currency. That's possible, but not here in the good old US. So it is good to know that it was designed to be a currency, absolutely does not have the features of the currency at the moment.
Quick question on one of the things that you just mentioned here. You talked about the volatility of Bitcoin. So what are some of the things that are driving the volatility of cryptos like Bitcoin?
Yeah, I think there are several factors. I don't know there's any one in particular. I think ultimately it is driven by uncertainty. Uncertainty is ultimately my belief is that drives that. And what I mean by uncertainty, when there's news that for example, China has put some major restrictions in place, either looking at the mining, which a lot of the mining is happening in China because of low electricity costs. And China started putting restrictions on that. Well, a lot of folks are looking and saying, well, they can't really be good for Bitcoin. Again, China has put forth the idea that they're going to introduce their own version of a digital currency, and it's direct competition with Bitcoin. And they specifically said, we don't want any other cryptocurrencies being used in China. So 1 in 6 people in this world are from China. So certainly when you have the government kind of putting that foot down and saying, well, that's not good, it's going to impact that uncertainty. It's going to impact the Bitcoin market. So there are a lot of things that are impacting the Bitcoin market. But what's also interesting is that a lot of the trades, as opposed to the stock market or the bond market, they are really done by smaller individuals, and the market is subject to a lot more. I wouldn't say fraud, but there are a lot more not only speculative but just pretty obscure transactions. So it's an unregulated market, and I'm not sure it's manipulation or not, but there are a lot of trades. It's not always clear how they happen. What we do know is that a lot of small investors are diving in. So the sentiment of the small investors does tend to move the market for Bitcoin. So this, again, it could be a negative sentiment as they hear about China, but it could also be a positive sentiment if they hear that Elon Musk is appreciative of Bitcoin, or Tesla start taking Bitcoin. Well, that's going to drive up the price. So it is subject a lot more to the emotions and to the human biases of smaller investors rather than large institutional investors, which tend to be a little bit more thoughtful, a little bit more detached emotionally from that. So a lot of reasons, but ultimately, in my view, it is the uncertainty around Bitcoin, is the uncertainty around how Bitcoin stacks up with other cryptocurrencies, because there are thousands of other cryptocurrencies, just like Bitcoin. So whenever news comes out that another cryptocurrency had a big win, and a win mean, for example, when the most expensive electronic piece of art was sold, it was not paid in Bitcoin, but a competitor called Ethereum. So at that point, obviously, people are like, well, Ethereum is on the map now. So what does it mean for Bitcoin? So because there's so many factors driving it, it's a crazy, a volatile investment. A lot of it driven by the emotions of small retail investors.
So it's interesting, the different types of cryptos that are popping up all over the place, from Ethereum to what is it, Dogecoin, to all the.
Oh yeah.
Maybe you could talk a little bit about who are the major players out there, or at least some of them, and like how do they even get started? I think it's for the average investor. You look at this and you say, okay, well, where did Dogecoin come from? Where did Ethereum come from? How do these things even get started?
So Bitcoin got started back in 2009, and at the time, it was something that nobody really paid attention to. And in fact, as a trivia, the very first transaction in Bitcoin is considered to be a guy in Florida who basically said, "Listen, I have 10,000 Bitcoins, and I'll exchange them for anybody who buys me anything." Or I don't know if he actually specified what he wanted, but he ultimately ended up getting 2 Papa John's pizzas for 10,000 Bitcoins.
well worth it.
I mean, if you multiply 50,000 by 10,000, it was an expensive.
I don't know. Papa John's is pretty good. So.
That was the very first transaction. So for a while, these are pretty dormant. Now, how do these get about? How do they come about? Some of them come in through something called an initial coin offering. And the idea is that people, anybody, anybody in this call can go and say, I'm going to create a cryptocurrency, and on that day, I'm going to launch it for anybody who wants to buy it. And if people want to buy it, then they put money into it, and then it has value. Some of them came out just as a pure joke. Dogecoin or Dogecoin or whatever it is, that came out as a joke. It's like, look, see how silly the people are to buy this thing. There's no value from the beginning. It's a joke. And yet it exploded in value, even though it was from the very beginning. Why? Again, because I think there's there are big human biases involved in situations where people see the fantasy of making so much money and the fear of missing out. So they start piling money in. And in markets that are pretty thin, in other words, it's not traded as much as you think, even smaller purchases can magnify the price impact, and that might lead to the huge increase in value or the huge drop in value for these currencies. So anybody in society can create them. There are tons of them, thousands of these cryptocurrencies. Some of them created as a joke. Some of them actually people, I can't say they're all legitimate. There are a lot of coins that were fraudulent. I think it was one coin that was launched by a Bulgarian, what appears to be a scam artist, and ended up costing investors billions and billions of dollars, because it's easy to do it. Anybody can do it. You can probably hire somebody on Craigslist to launch yourself a Bitcoin, and then it's just a matter of going out there and selling it and getting people to buy it.
Yeah, it's interesting too, and I think it begs the question. I mean, clearly, governments like ours will make every attempt to try to regulate it in some way possible. Maybe we could talk a little bit about how Bitcoin is different from our traditional investments like stocks and bonds, and also maybe just speak a little bit to the regulation side of not just Bitcoin but any crypto.
So it's a very good point that he touched on, Michael, because if it's not a currency, what I think happened is a lot of people looked at Bitcoin as an investment. An investment in their mind is a way to make money. And what's wrong with just looking at the numbers and saying, well, listen, this Bitcoin was worth $10,000 not too long ago. Now it's worth 50,000. Wow, why not participate in this? It's an investment. That's what an investment tends to do. It grows your money. And in that respect, how would you think of this investment as being different than what you would typically consider in a portfolio for an investor, which namely is our stocks and bonds and maybe real estate? Well, when you buy a stock, what you actually get is ownership. You have ownership into a company, into a business. And why would you want to do that? Well, if you have let's say there's a local ice cream store. And if you are part owner into that ice cream store, as the ice cream store makes money, you are entitled to part of the profits of the ice cream store. That's if you talk about a small business. When you go to the stock market, it's exactly the same idea. You buy ownership into a company, and because you are now part owner, you are entitled to a fractional ownership of the earnings and the profits that the company makes. That's the value. That's where the stocks get their value. So, in a way, you can sort of estimate, like, how much should I pay for this ownership? Well, if you look at the ice cream store, you say, well, they sell, I can look at the books and say they sell 10,000 cones a night, and they make a profit of $1 a night. So I can see how much their money they make and how much is it worth for me to put up front to buy that business. It's the same in the stock market. You try to estimate how much Apple and Google and Facebook they're going to make in profits. And then you kind of look back and say, today, this is how much I would pay to buy those profits from the future. So that's what a stock market does. It gives you ownership into a company with real people, real products, and hopefully real profits. Bonds are a different thing. Bonds allow you to lend your money to corporations and governments around the world. And there is an interest rate spelled out in a contract, and you receive that interest on your money for a period of time. And at the back end, you get your money back. So the good news is that you know exactly what you will receive in terms of interest payments and the principal from these bonds. And you know exactly, meaning like it's spelled on the contract. Sometimes they might not pay out, but the majority of bonds absolutely certainly pay the interest and the principal back. But as an investor, what am I expecting to get? If you buy a building, Michael, you can go rent it out. You can look at the rent that you expect to collect and find the value of that building today. So what's interesting about investments, the way that we look at it from an evidence-based approach, is that there is a valuation. You can determine a valuation. It might not be perfect, but you get a sense of a valuation. And that's what makes stocks, bonds, and real estate, in my view, different than Bitcoin. Why? Because Bitcoin doesn't produce anything. It doesn't create anything of value. It doesn't pay interest. Bitcoin only has value because other people believes that it will have a greater value in the future. But that is a pure belief. It's a pure speculation, because there's no way that anybody can value and give some fundamental sense of how much is this worth it, because it doesn't produce anything. It absolutely doesn't produce anything. So in that respect, you can value it. So stocks, bonds, and real estate can be valued, and you can say, you know, it's expensive or it's a good deal. There's none of that with Bitcoin because it doesn't produce anything. 60,000, is it too much or too little? I have no idea. $60, is it too little or too much? I have no idea, because it doesn't produce anything. All the value comes from is the belief that people have that they will be worth more in the future. And not too long ago, I was cleaning, still embarrassing, but a while ago when I was in I think it was undergrad or grad school, I forgot exactly. I was cleaning one of my storage rooms, and I found a Beanie Baby. And I remember that I had a roommate, who was really insistent that you can make a lot of money in Beanie Babies. And she said, listen, buy it now, because the value of Beanie Babies will go up. And the same Beanie Baby, you can sell it for 3 or 4 times as much. And I was like, that's kind of silly. Who would want to do that? I mean, it's crazy. Well, she was right. I ended up making quite a bit of money in these Beanie Babies, and I bought more and more Beanie Babies until the craze was over. And then I got stuck with a bunch of Beanie Babies that had no value. And it's kind of the same thing, is that in my view, I would make money because somebody else would be foolish enough to pay more in the future. I don't know why, but it's a little bit like that with Bitcoin. The value comes from the fact that people believe that this should be worth more in the future, but there is no basis for that belief. There is no fundamental way to value and say, yeah, it's going to generate revenue or profits or interest. It does none of that. So in that respect, I think more of stocks, bonds, and real estate as an investment in the pure sense, and I think more of Bitcoin as a speculative investment, something that it could pay off big time. It might not pay off, and it's everything is sort of. It's a bit of a gamble. It is pretty much a gamble. It might or might not pay off.
So what you're saying is you should be selling your Beanie Babies for Bitcoin. And
yeah,
maybe
one another, kind of like it's the same principle. Yeah,
there you go.
Or they should be like a Beanie Baby cryptocurrency.
There you go, a beanie currency, something like that. Well, so obviously when we get questions about this from our clients, the big questions are, all right, well, what are some of the risks if I do decide to? I've heard a lot of people say, yeah, I'm gonna take a little money over here on the side, I'm gonna play in cryptocurrency. So, is it safe? What are some of the risks? What have you seen out there in the landscape?
Yeah. So I think that might not be a bad way to think about it. If you believe, and I've met plenty of people who really think that buying Bitcoin says something about who they are. They're interesting people. It gives them a topic of conversation. It puts them on the forefront, of the edge, whatever. It satisfies whatever need they might have. I actually don't see a big problem if you take a little bit of your assets and you do this in a speculative way for whatever reason, whether it's entertainment or it's because of what it says about you, or you think you can hit the jackpot with there. If you do that with a limited money, I got to tell you, there are a lot worse places where people spend their money. A lot worse places. I mean, I'm not talking about Vegas, but there are a lot of other places that are, silly way of spending money. So if you want to do that, I can't say it's a terrible thing. The risks that you're talking about, I think that they come from a few places. The first risk is that there is a lot of fraud out there, and you got to be so careful. And it's not just fraud, people coming and stealing from your from your account, but it's possible that where you transact, that might be hacked into and money might be stolen. One of the biggest thefts happened to an exchange called Mt. Gox a few years ago, and there were billions of dollars who just disappeared, and you cannot really track them down. So the first risk is fraud because it's unregulated. The second big risk, which I don't think people should underestimate, is that the risk is that the value of your account resides in the fact that you have a digital wallet on your computer. So instead of a wallet in your pocket, you have a digital wallet on your computer. And in the digital wallet, you have a number and you have a passcode, and that allows you to send money or receive money into that digital wallet. The thing is that the digital wallet is you got to be careful with it, because if you happen to lose the password, it's not like a bank. You call the bank and you say, listen, I lost my password. In a few minutes, you have access to your money again. If you lose the password to your wallet, you have 10 attempts to regain entry to the account. If you actually put in 10 wrong passwords, that money is locked up and gone forever. There was an article in the New York Times about an individual who had in excess of $200 million in their account based on how many Bitcoins they had. But that person lost or forgot their passkey. And they had tried 8 times. They had 2 more tries. After that, the money was locked up forever. And you can't really recover that. You can't hire anybody to do it because the system was designed to be robust in that way. So be careful, because how many of us have not lost a password? And do I really want to have so much money into something that I can't claim back? The second one is if something happens to your hard drive, or if the computer gets lost. Once again, it's if you don't know your digital wallet and the computer's gone, you might not be able to retrieve that. So you got to be super careful where you hold this, because there's anonymity, but also means that there's no way to retrieve money should something go wrong. And then there's risk in other ways, which I wouldn't call risk. I think it's more that to the point that he made earlier, there's more regulation. We never touched on this, but there's more regulation because the government is saying that this is a bit of a lottery ticket where people are buying and selling these lottery tickets, and it's a little bit like of a speculative aspect, but some people do make money. And a lot of them are not really declaring these earnings because they don't even think about it. And then the government comes after you and says, wait a second, you need to declare these. And now there are proposals to really button this down. And if you have any transactions in Bitcoin, pretty much like everything else, to declare them. And on the tax forms today, there's a line specifically around cryptocurrency. So the risk is there that you might not even have thought that this is a taxable event, and you miss that, and the government comes after you.
Okay, so we do have a question going back to when we were having a conversation about value. This question is: can't you argue that the dollar has no intrinsic value either, because the dollar only has value because there is a mutual agreement that is actually worth something? So it's just a little bit of a question on intrinsic value.
Correct. So you're absolutely right. So up until the 1970s, early 1970s, there was a link between the dollar and the dollar and gold. And we had something called the gold standard. So the government could not print another dollar unless there was more gold to back it up. And in the early 70s, Nixon basically severed that link between gold and dollars. So dollars could be printed. And to the point that the audience made, which is very perceptive, is the value of gold of the dollar now, the paper bill, is just simply in the fact that we believe that the government won't just print money forever, and they'll be judicious about the way they print money. And they're, and if I use that money, somebody else will accept it. So in that respect, it's absolutely true that the value of a dollar is not, it's backed up by the faith of the government, the faith that we have in this currency and the government. And that's been the case, even before there was a gold standard. It's always been the case that it's not new. There are great stories about other currencies throughout history that has just been backed by the faith in the government. The difference is that right now the dollar, it is the currency that is legal tender in the US. And through all the things that we've been, the dollar really hasn't lost value. We had the inflation in the early 70s and a little bit in the late 70s and early 80s. But those were aberrations caused by as I said, the sever of the link. We had the oil crisis and the OPEC embargo, and so there were some situations that created this inflation, which is about 10% back in the late 70s. But outside of that, the dollar has done a tremendous job of holding its stable value. So in other words, yes, we do have it, but this is, on one hand, you have a legal tender that is the U.S. government. You pay your taxes. Everything that we do is in dollars. And then you have something that only a fraction of the people have it, and it's still backed by the same faith. So just because it's backed by faith, it doesn't legitimize Bitcoin. It just basically says, yeah, in that respect, it's the same as a dollar, but there's so many other differences. Now, one more thing. I also hear people sometimes kind of thinking that the fact that there's a limit on the number of Bitcoins that can be produced, it's actually a good thing, because you don't have runaway number of Bitcoins the same way that you could have with dollars. Again, with dollars, listen, the dollar, the greenback, has been through so much since, for 100+ years, whatever, since 1776. And it's worked just fine. And Bitcoin, it's almost like a solution searching for a problem, because it's been working really well if you actually take a deep look, and everybody believes in it. Now, the thing is that some people are concerned that perhaps we're printing too much money. Well, here's the thing. The fact that Bitcoin has a limit, it's actually a huge drawback. Because the reason that we have to move away from the gold standard to the type of money we have today is because there was a limit of how much gold can be produced. And as the economy got bigger and bigger and bigger, you had more and more and more and more people, you couldn't print enough dollars. And the whole economy was basically hamstrung by this lack of dollars. It's the same with Bitcoin. As we have more and more people, and this is limited at 21 million, what's going to happen if you don't have something to grow? That's going to have the same fate as the gold. You cannot constrain it. The money supply has to grow because we have more companies, we have more production, we have more people, and if you don't keep track of increase this, it's going to have the same fate. You will have to be unplugged from the economy, because a limited supply will reach a point where the whole economy will be tied and you will be hamstrung by the lack of new currency issues.
Okay, interesting. So probably the biggest question out there from investors is, okay, so we have some people that say, all right, I have a little play money over here, I'm going to put it into Bitcoin or something like that. But what about investors who are asking, should I consider, diversifying my portfolio a little bit and putting it into some form of crypto? I know there are funds out there right now that deal in different types of crypto and things like that, I believe. But so what would you say to the average investor? Should they consider putting it in their portfolio?
So my first thought to an investor is that the first place that an investor should go is talk to an advisor, because what you should invest in it has two very different tracks. And one of them is growth. You grow your money. This is where Bitcoin would fit in. And what typically grows the money beyond Bitcoin would be something like the stock market. So the stock market would be sort of providing the growth engine to your money. But a lot of folks, particularly as you get close to retirement, or you just don't have the risk capacity, then, alternative to the stocks, which provide the growth, should be invested in bonds. So the first thing that I would tell you, it depends, because the first thing that you should consider is that trade-off between the stability of your money, which comes from bonds, versus the growth, which comes from stocks. And I have to tell you, I meet a lot of retirees who are extremely comfortable knowing that their nest egg is quite conservative. There's not that much fluctuation in value as they need to draw money out. So having a portion in bonds to them is really comforting. And it's really the smart thing to do. And that's what a financial plan would accomplish. So the first thing that I would say is that you need to differentiate the growth assets in your portfolio from the stability, the preservation of your capital, which comes from bonds. And there's no right or wrong mix. This is what a financial plan will help you determine. And that's why Level FA can be extremely instrumental in figuring out what's the right balance for your specific needs, for your circumstances, for your risk capacity. Now, if you look at the growth portion, the one that you want to grow, stocks is one of them. And in that category, you can argue that, what should I put crypto? By the way, I would never put crypto in the other bucket, which is bonds, because it fluctuates way too much in value relative to bonds. So if you want to put in the growth bucket, the first consideration that somebody should have is, what I invest in has to somehow be proportional to the overall value of that company in the bigger scheme. What I mean by that, when you think of let's take and I don't want to pick on any one company, but let's just take Shake Shack. So Shake Shack is a burger joint. And we all know some people are more familiar with it, or Dave and Buster's, or Buffalo Wild Wings. All these are publicly traded stocks. And the question is, how much should I invest in those companies relative to Apple, relative to Google, relative to Microsoft? And what you find is that, boy, Apple might be about 2 or 3% of the value of the entire U.S. stock market. Well, maybe I should allocate more to Apple than I should to these burger chains or restaurant chains. And the idea here, this is called market capitalization. So you look at the weights and you say the percentage that I allocate to the larger companies, it should be greater than they allocate to the small ones. And that's a principle that we all kind of agree with, that it makes more sense. It has more economic meaning. Now, when it comes to the value of the overall stock market, and you compare it to the value of the overall, let's say, Bitcoin, it's quite eye-popping. The value of Apple right now, I don't know, let's just call it $2 trillion. So Apple is a single company in the US stock market, only in the US stock market. And the value is about 2 trillion. When you put together all the Bitcoins that exist out there, it's less than $1 trillion. Now, what I'm saying is the entire value of Bitcoin is perhaps half of the value of Apple, which is one company. And if you look across the entire world, when you add up BMW and Toyota, and you had, Honda and all the other companies that exist around the world, Sony and Samsung, when you put them all together, what you find is that the value of Bitcoin relative to everything else, all the stocks in the world, is about 0.5%. So it's less than 1%. Let's just call it less than 1%. So if you're thinking that I should include Bitcoin into this investment, this my portfolio, then obviously my first suggestion is, if you choose to include it, you should make it relative to the value of all Bitcoins relative to the stock markets around the world. And that's a really tiny percentage. And I can tell you folks that, let's say that you split stocks and bonds, 50% in stocks, let's just for argument's sake. And then now, out of the 50% in stocks, you're going to put some money in Bitcoin. It's going to be a tiny percentage, and nothing in that less than 1% is going to have a meaningful impact in the portfolio. So to me, if you were to do it, I wouldn't say it's a diversifier, because the percentage that you would put would be so tiny. If you want to put more than that percentage, then at that point, you're kind of speculating, you're placing a bet. And I'm not a big fan of that. So ultimately, kind of comes back to this. If you want to make it part of the portfolio, it is such a tiny percentage that it's not really worth it. The juice is not worth the squeeze. And if you want to do it, I would take it outside of your allocation and just simply say, I'm going to take some money. I'm going to put on the side. I'm going to watch it because it's entertaining. It's fun. But I also know that it's not in the same bucket with my assets that are designed to take me through retirement and give my next generation a fighting chance. And so I would separate these two because the percentage in Bitcoin is so tiny, but also the mandate, the idea of Bitcoin is very different than what's in the rest of the portfolio. So the answer is I would personally not consider it to be something that is needed in the financial plan and the allocation, the portfolio allocation. It's too small of a percentage, and you're better off taking some of that money. And if you want to do it on the side, I can't argue. I cannot argue with that.
Okay, so here's a good question directly related to that just came in. Is using something like Coinbase Wallet a good way to separate it from your retirement assets? So Coinbase is pretty popular. Maybe a couple of words about that.
Absolutely, absolutely. Do it. I have friends who do it. They put like $100 a month or something for fun, and to them it's entertaining. It's like, I live in LA, and instead of watching the Dodgers, they don't really care about the Dodgers. A lot of some do, some don't. But it's like watching a sports team, and they get a kick out of it.
For the sake of anybody on the webinar that doesn't know what Coinbase is, maybe just give 30 seconds on what it is. And
so what Coinbase is, and what's happened is that as companies realize that people like trading these, they start saying, well, we can make money off them. So Coinbase came up to be sort of an exchange where people can go and trade these, and they can hold their digital wallets on Coinbase. So in that respect, it's a way that these companies are trying to make money off you, because when you transact in Coinbase, you pay about 1% of the value of the transaction to Coinbase. So they figure out a way to make money. They're completely agnostic. They don't care at all about Bitcoin. They just want to make that commission when you trade. So they're like a commission-based way that you can broker. They can broker transactions between buyers and sellers. Again, if you want to do it, do it. Bitcoin is now a publicly traded company. Obviously makes money since so many people trade. So they're not supporters of Bitcoin per se. They don't necessarily believe in Bitcoin. They just make money off it. They make money off the people who believe in Bitcoin. So I would say Bitcoin is a perfectly valid. I'm not here to validate to say that one is better than the other. Bitcoin is a perfectly fine. It's a publicly traded stock. But I would say that's a good way to separate. I would probably a better way to separate in my mind is whatever I have at my advisor. That is to me, the family money, that's the money that would carry me through retirement and afford me the lifestyle that I want. And that to me is money that lives with the advisor. It's managed professionally. It's based on a plan. That to me is the allocation that it's the cornerstone. If I have some accounts on my own, whether it's Coinbase or I like to dabble in something else, that should be under your control. And that would be more where I would fit in Bitcoin.
Okay, really good question came in, and it was good because I wanted to ask this question too along a different line. But going back to investing in stocks versus putting money in crypto assets, can't we view an investment in a utility token like Ether as an investment in technology? So a growing number of apps are being built on the Ethereum blockchain and a few other popular ones. Additionally, Ether will soon be deflationary by the end of the year. So, the question really is that, maybe not so much Bitcoin, but the technology that it sits on could become a pretty big player in the future. What are your thoughts on that?
And absolutely, I have no doubt that and this is my personal opinion, that the technology, the online technology, the blockchain technology, some of these things are absolutely going to be useful going forward. It's just that we don't know the iteration under which you will be able to make money. If you think of Palm Pilot, I think it's a pretty a good example. If you look at Palm Pilot, when it came out, it was innovative. It was the thing that to have your PDA, personal digital assistant. I had my contacts, I had phone numbers, I had everything, my calendar, all into the device that I could carry with me, even make phone calls. And that was a tremendous thing that innovated, and it changed everything. A lot of folks are saying, boy, Palm has really hit it because they got something, the technology that nobody else has. Well, it turns out that they made some money initially, but the technology that they had, it's still with us today, but it's not a Palm device. It's an Android. It's an iPhone. The idea is that the technology that exists right now, it will change, and it's not clear to me which one will be the winner. If you want to bet on technology, I can tell you that plenty of publicly traded stocks are incorporating that technology into their system. So you are participating in the success, the technology. You are participating in that technology, just not as a standalone, but rather as part of companies that you might already own in the stock market. And you have to think, it is as interesting as this technology is in the bigger scheme of things, in the scheme of AI, in the scheme of all the things that are being done, cloud computing and all that. How relevant is that? I would say that when you look at computing, and I'm not an expert but I know enough that you have AI, artificial intelligence. You have self-driving cars. You have a lot of technologies that are coming on the medical field. You have so many other things. This is just one of the technologies. And do you really want to place such a big bet on something that's kind of niche? It's already being used by a lot of companies, and it's a tiny percentage of all the cool things that are being done in tech. So I would not, again, it's a bit of a bet. And if you want to place it, if you think that's going to work, again, take some money and and if it's sand play money, that's fine. But I don't believe that you should place a big bet on this, because it's not as relevant as other things. You have energy, batteries. So I can make the same argument for batteries. There are companies out there, they're looking to revolutionize how batteries, you have solid state batteries, which are a lot more relevant to the economy than a particular, crypto blockchain technology.
Okay, well, good. We have no other questions. I'll give a couple of seconds here to see if anybody has anything else they want to add. But no, nothing else coming in here. So I guess what I'll say is thank you very much, Apollo. It was a quick 56 minutes or 51 minutes of crypto talk. And for everybody on the webinar, we'll put it together. We'll get it out to you via email in the very near future and make it available. And then, of course, if you have any questions, you can always hit us at invest@levelfa.com, and we will try to answer those questions for you, or maybe we'll just forward them to Apollo and he can answer them. So everybody have a great evening. Thanks for joining us, and take care.
Bye-bye.
Bye.